We move on now to our second leading story. South Africa's Finance Minister, Malusi Gigaba, delivered his maiden medium-term budget policy statement in Parliament on Wednesday, cutting economic growth from 1.3% to 0.7% for this year and forecasting debt to reach $210 billion by 2020. He also indicated that the economy will expand by 1.2% in 2018 and 1.5% in 2019, suggesting slow growth. Now, Mr. Gigaba's mini-budget proposal has triggered reactions across South Africa, with many South Africans and experts alike making reviews of the budget.
Yes, Jerry, many experts warned against the fact that South Africa would see its rating downgraded again by the end of this year. According to rating agency, a further decline in South Africa's credit ratings could result to a capital leakage of 80 to 100 billion rand, that's about 5.8 to 7.3 billion US dollars, which has a serious repercussion on the national economy.
Chief Africa economist for Standard Chartered, Razia Khan, joins us now over the phone from London. Thank you for joining us, Razia. First, South Africa's minister's mini budget is eliciting very strong critical reviews. But one thing that's certain is the budget suggests a lower growth for South Africa's economy. Also, the entire economy is intertwined with the president's corruption allegations, including influence peddling with the heads of state-owned companies. Razia, could you tell us how will all of this affect the economy's performance, if, of course, already affecting the economy's performance?
There have been two concerns almost side by side in South Africa. The first is, of course, that economic growth has been weak, and as a result of that weakness, revenue collection has underperformed previous budget targets. As a result of that, South Africa is now showing for the current fiscal year a much wider budget deficit, 4.3% of GDP, compared to what it had been expecting to demonstrate, a deficit of only 3.1% of GDP in the past. And also, quite worryingly, the expectation is that growth is going to remain weak over the medium term. There's really much confidence that growth will exceed 2% over the medium term. The budget deficit is now projected to stay at just under 4% through to fiscal year 2021. So there are big issues with that. Another issue alongside this is the kind of support that South Africa's state-owned enterprises might need. Up until now, there has been recognition that there were issues around the running of city-owned enterprises. Often boards were not seen to be running the SOEs in a way that was necessarily making them profitable. Many have needed bailouts, state bailouts, and the authorities have been quite careful to separate that support out from the core budget of the country. So, for example, the state-owned airline in need of an equity injection will see those funds largely as a result of planned privatizations. This isn't something that is supposed to impact on the fiscal deficit of the country.
Razia, one of the things Gigaba, the finance minister, has proposed is a sharp increase in tariffs as a solution to electricity companies' Eskom's financial constraints. Do you think this is the best approach to solving the South African electricity utilities challenges?
There is a broad-based consensus amongst most economists that cost-reflective tariffs are indeed what is needed to ensure the financial viability of any utility anywhere. Now, Africa in the recent past had had a lot of problems with electricity supply. There hadn't been sufficient investment in new generation capacity for a while. There were issues around how the state-owned utility was being run that resulted in these financial losses. Allowing for an outsized tariff increase, what has been proposed for the next year is almost a 20% increase in electricity prices, will of course go some way towards plugging. It might make up for some of the gap in Eskom's finances.
Let us shift our gaze a little away from that to taxpayers now. In a bid to stabilize the debt and GDP ratio, the National Treasury has suggested higher taxes, targeting $2.8 billion that must be collected in the 2018 to 2019 financial year. How could this affect the ordinary taxpayer in South Africa?
Not at all, and I think we need to be very careful of the interpretation of the numbers in the medium-term budget. What was entirely absent from this year's medium-term budget is the usual corrective policies that are put in place when revenue is subject to pressure, when there has been a substantial revenue undershoot. In the past, if it looked as though revenue was not performing well, we would typically see the Treasury looking for ways to raise taxes. We need to be absolutely clear. The projected increase in revenue mobilization that is factored into this budget is not the result of meaningful changes to the tax regime. So, in effect, no new major taxes have been proposed that would create an additional burden on South Africans, but also help to plug that fiscal deficit. This is ultimately still an issue that should be of concern to any South African consumer because of the idea that if a government is running up bigger deficits, has greater levels of debt, at some point they're going to have to repay that. It isn't a big feature of this budget just yet, but that is no reason to celebrate.